From New York City, I'm Tom Keenan in for John Farrow. Well, with 30 minutes dedicated to the fixed income markets, this is Bloomberg Real Yield. Coming up, will it be low rate Kevin as the president meets to greet former Fed Governor Kevin Warsh? In this hour, will Chairman Warsh keep the real yield lower for longer? Well, on the edge of a hockey stick, that's what we saw this week. Yellen speaks. The nominal yield spikes higher. Will transitory September give way to an inflated October and December? In moi, not Farrow, me, moi, a real yield hog, we consider the frenzy over the loan market. And we start with the big issue, interest rate risk in the bond market.
During the summer, it was almost as if bond investors were making another run at treasuries, man. They just wanted to get that 10-year below 2% just one more time. And it was really built on the base of America's never going to grow again. We're not going to see any kind of fiscal policy. And it was really about growth. And I think they had it completely wrong.
The Fed is moving towards regaining credibility with investors. So investors in the market, they feel like, okay, we know what their plan is. We can make investments based upon this. And you're going to see people reacting.
The Fed has come out very clearly and said, this is what we want to do. They want to reload their cannons, right? They want to get the balance sheet down, and they want to normalize the front end of the curve. And so you've seen the betting odds on the December hike change dramatically.
The Fed views low inflation as allowing them to continue with a gradual pace. The market thinks the Fed shouldn't touch rates unless we're actually at 2% inflation.
I do believe Janet Yellen. I do believe that the U.S. economy is strengthening more quickly than perhaps been expected early in the end. I do believe that there will be a rate hike in December. So this time I think it's for real, but it has been well signaled, and I think markets will take it in their stride.
Join me now on Real Yield today. We've got a terrific lineup. Three pros worried about that interest rate risk, and of course the news that we see this week on Kevin Warsh and other potential Fed nominees. Jim Keenan is Chief Investment Officer, Global Co-Head of Credit at BlackRock. Joining me as well in New York, Rachel Golder, Co-Head of High Yield and Bank Loans at Goldman Sachs Asset Management. And joining us far and wide, time zones away, Mark Kiesel joins us from Pimco in Newport Beach, California. This is going to be a great reset, if you will, into the fourth quarter this year. Rachel, let me start with you. Bring up this chart, Daniel, if you can. This is the VIX chart. It's an equity chart. Brian Belsky up in our video there earlier, an equity guy. You look at the equity quiet, there's bond quiet as well. We're down to historic monthly low in the VIX. What's it mean? How big a headache is that for you at Goldman Sachs?
We do think volatility is due to rise in the course of the next year. It's likely to be a result of the beginning of tapering. We think we're coming out next week with a client piece, the subtitle of which is
come on, we're making
the long unwinding road.
Give us the long unwinding road.
Unwinding road. Right. Globally, central banks are going to be unwinding. It's not from the same starting point. They're not doing it at the same pace, but it will begin to tighten financial conditions into next year. We think between the tightening financial conditions and the potential for political risk and policy risk that there's likely to be higher volatility, and therefore the trend in spreads is going to be higher.
So one view there from Goldman Sachs. Mark Kiesel, to you at Pimco, the basic idea here of hard data, soft data, can we develop a theme now? Do we have enough confidence in the path of the hard data?
Tom, you brought up a great point, and the word confidence. I think if you look at Yellen, you look at what she said in her Q&A in her recent speeches, she's sounding increasingly confident, and I think that's because the labor market's doing well in the U.S., the consumer's healthy, financial conditions are very easy, and the global economy is actually doing, I think, better than a lot of people expected. So this is giving the Fed confidence that they can take a step back from this large balance sheet support. I think the market also has mispriced the fact that the Fed probably will go a little faster than most expect. Right now, the market for December is priced about 60%. And really, cumulatively, until the end of next year, less than 2 rate hikes. So our view is that you are going to see a little bit more aggressive Fed, particularly versus what markets are expecting. And therefore, the trend towards higher rates is likely. And we're likely going to see the Fed move and also other central banks over time start to step away from the support for markets.
Into that idea to go to Jim Keenan, I want to bring this in, published on Friday. This is the great Stephen Englander, ex-Citigroup, now over at Rafiki Capital, and he really pushes against the Fed's certitude. The market is greatly overestimating the votes and the commitment to hiking at the FOMC, and then he turns within his research note and says the next inflation print has to deliver the bounce back to normal inflation. Jim Keenan, how urgent is it within the Fed linkage into the real yield market to finally see actual inflation data, as Mark mentions?
Well, I think there's a lot of long-term secular headwinds to sustainable inflation. I do think that inflation is definitely picking back up, and agree with Mark's points. You're at a point in time where it makes a lot of sense, and it gives the Fed confidence with regards to where we are, with regards to the underlying economy, the labor markets, that they can start to reduce their balance sheet. That being said, there's still a lot of aggregate debt in the system that is still going to put long-term headwind onto inflation. So I still think it will be an outline by the Fed. They will continue to reduce their balance sheet and hike, but at a moderate pace relative to what's going on in the underlying economy.
This is an incredibly important chart. I want to thank Robert Cinch at Amherst Pierpont, of course, ex-Bear Stearns and Bank of America for this. I'm looking down here at the Faro Bloomberg terminal to make us wiser. And I want to go to all three of you on this one chart. I usually, Rachel, don't do that, but it's so important into the fourth quarter. This is the inflation-adjusted Fed funds yield. Stan Fisher down below here in the lower right corner looks at an ultra-accommodative Fed, that real yield way, way down below the zero mark. Well, we've come up. Where are we? If Chairman Warsh shows up tomorrow, where are we in the continuum from ultra-accommodative to something called normal?
Still in early stages, but we will be normalizing. And I think whether it's Warsh or whether Yellen remains, there is an intention to continue to tighten. There's a recognition that we're quite loose, even though inflation is not yet present. But there's a sufficient inflation, I think, to give them cover to continue to hike. So I actually agree with my two co-panelists on the.
We got to stop the show. They all agree. We don't do that here at Bloomberg. We have to be massively disagreeing. Mark Kiesel, let me go to you with the basic idea, and you stated further that this is a Fed that's going to lead the market forward. Where are we within the rates where we're even on the edge of normal? Can I dare say it as 2019?
Well, Tom, look, I think we're heading to 0 to 0.5% in terms of real rates, so probably 2 to 2.5 real. But this is really striking, and it brings up an interesting point in that if you look at developed markets in the U.S., Europe, Japan, you've got negative real yields, particularly out to 10 years in the case of UK, Europe, and Japan. And this is in sharp contrast to what's happening in emerging markets where inflation's actually falling in some countries and their central banks are lowering rates. So you've got central bank divergence between some emerging markets and most of the developed world. So our view is simple. You want to be more cautious on developed market interest rate exposure. And if you're going to take interest rate exposure today, have it more in floating rate form as well as select exposure in emerging markets.
We're going to talk about some floating rate issues here later in the half hour. I want to bring up the screen right now just to give you an example of where Mr. Kiesel's talking about a Europe that's different. This is Switzerland. Bring in the camera, if you would, to the upper right corner. Jose, bring the camera in here to the upper right corner if that's possible. And you got negative yields in Switzerland, 2-year, 3-year, 4-year, 5-year, 7-year, 9-year, 10-year. And we used to have negative yields out to that 0.366 20-year note. I mean, Jim, that's how artificial the market is. And does it suggest that this is actually a Fed that's more normal than anyone else?
Yeah, I think it's a good point here. I think we're entering a new phase here post the financial crisis in the sense that, you know, we had a cycle, right, where everything kind of correlated to one, and then central bank response and fiscal response all came in at the same time. We've kind of got to the point now where economies are in different places, and there's different levels of cyclicality that are going on in different regions, and so you're starting to see central banks around the world acting more regional as opposed to coordinated effort around this. And I do think you will continue to see volatility be low. That being said, I still think you'll see dispersion being high when you're looking at different industries or different regions around the world as they balance a cycle. But I do think that, you know, you're in a longer period of time where you're still going to have low rates, and normal still means low.
And we heard this week clearly the idea of central banks at different locations in the cycle is absolutely key. Rachel, I want to get the hands out here, and I look at the real yield and the inflation on top of that, the nominal yield. Where does Goldman Sachs think that dynamic's going? Dominic Constant over at Deutsche Bank suggests a better real economy, even with subdued inflation. Where is the real yield, nominal yield dynamic going to work out over the next 12 months? Oh, I need all that in 20 seconds. Can you do it?
We think they begin to compress against each other, that both nominal yields will continue to rise, that we will begin to see some inflation coming through. We are believers that there were temporary inflation factors pushing inflation down that will be coming back through into the market early next year. So while we're believers that there's going to be a lower terminal rate when we reach the end of this cycle, there's still some upward room. And so we're short U.S. while we're relatively more positive in Europe.
Okay, well, we'll talk about that through here. I know everybody wants to jump in. A very nice opening section here. A real yield. We'll continue with Mr. Keenan of BlackRock, Ms. Golder of Goldman Sachs, and Mr. Kiesel at Pimco, smarter than us, out in the beautiful weather of Newport Beach. Coming up, we'll look at the auction block. Well, McDonald's, they head to the debt markets in Canada. Stay with us. This is Bloomberg Real Yield. And you expected Jonathan Farrell. He's on assignment. I'm Tom Keene, and this is Bloomberg Real Yield. Want to head to the auction block right now. Let's get through this quickly here. It's always interesting. We head north to Canada. McDonald's, they priced $800 million of bonds. The Maple bond market, I love that. Why can't they call it Les Habitants bond market? The Maple Leafs bond market on track to be the busiest since the financial crisis. Meanwhile, in the Middle East and Saudi Arabia, they raised $12.5 billion from its second dollar bond sale this year as the kingdom bolsters its finances amid an economic overhaul. Of course, we heard much about that this week. And with U.S. Treasuries, the yield for this week's $26 billion two-year note sale hit the highest level since October 2008. We migrate back 10 years to the financial crisis. We do that with Jim Keenan of BlackRock, Rachel Golder with us of Goldman Sachs, and of course Mark Kiesel out at Pimco. Mark, let me begin with you on the appetite for paper. Real yield is not only about the strategy and the economics, it's about the demand for paper. Is it a frenzy yet? I mean, if yields are going to go up, and Kiesel's going to tell us yields are going to go up, it's like everybody going out the theater door. What's the appetite for paper right now?
Tom, the demand for high-quality income-producing assets is huge in the world. And simply put, it's overwhelmed by the supply. Even though you've had $1 trillion of investment-grade corporate bond issuance year to date, it has been met with significant demand, and credit spreads have tightened throughout this year. What you're going to see going forward, I think, is more range-bound spreads. I don't think you're going to see tighter spreads going forward, but I think most investors, quite frankly, have underestimated how strong these technicals are, the demand for income out there in the world. Yeah. Central banks at the margin are going to gradually normalize, and I think that can cause technicals to change at the margin. But right now, these technicals are very, very strong.
Jim, this is an extraordinary of interest. Years ago, I heard Sir John Templeton say quietly in a meeting with that beautiful Tennessee accent, there will be a shortage of paper. And that's where we are. Explain to our audience that hasn't read Fibozzi, explain why there's a shortage of paper. Where is that animal spirit from where I've got to load the boat on fixed income paper?
Yeah, I don't think it's just fixed income. I mean, I think, honestly, we're
in the equity market as well.
Yeah, I mean, we are in a different environment, right? If you went back 10 years ago and you want to be conservative, you can own cash and still earn a 5 to 6% return on your cash assets. When you look around the world, if you're going to own fixed income assets right now or cash, in general, you're going to earn something that is below your goal of your liability or your long-term retirement goals. And so we do see a demand for high quality assets, but that's also because you have an improving economic environment that has been buoyed by a fiscal and monetary stimulus around the world. So asset prices have risen, but the risk profile still looks pretty good relative to the underlying economic environment.
And so then, Rachel, and all of you are sort of from the same idea of, you know, I don't want to lose money. I want to make the coupon and find some total return. High yield has had a wonderful run. Are you more high yieldy now? High yield, I mean, are you on moderately speaking terms with your corporate desk at Goldman Sachs, or are you all high yield all the time?
We're actually pretty cautious on high yield right now, although we don't see the end of a cycle anytime soon. We think valuations are pretty tight given that there are increasing pockets of risk in the market, and also the view that as financial conditions tighten into 2018, you'll see a steepening of the quality curve.
Let's do this. This is important. Pharaoh can't do this. I can do this. You put your hands up like this to describe it. You got full faith and credit down here. This is their yield. And Rachel, you're watching high yield come in, and this is tight, right? But then they can both move. What happens to high yield if Janet Yellen's inflation becomes less than transitory? Do they go up together? How does that dynamic work?
Historically, high yield has had an inverse relationship with treasuries, but that's usually because rates are rising when the economy is strong. The economy's already been strong and spreads are already really tight, so there's not a lot of room for spreads to go. And furthermore, we think that, again, rising rates is going to begin to tighten financial conditions. So we actually think spreads are likely to leak wider, not taking away maybe the total return of the asset class, but slimming it.
Mark, I know everybody out at Pimco eats kale, and you haven't been in a McDonald's, you know, in 3 years or something with your kids. Help me. We saw the McDonald's auction deal. When a AAA blue chip corporate like McDonald's come, how does that deal get done? How do you get the paper you want?
Well, Tom, and I haven't eaten fast food in 10 years, so probably not the biggest McDonald's fan out there.
Me like 10 minutes. Continue.
Yeah. So, I mean, obviously investors are all competing for supply. And what's happening right now is the issuer has the advantage because the financial conditions are so easy. So many of these corporate bond deals are being met with incredibly strong demand, 2, 3, 4 times oversubscribed. So what we're doing is we're being a lot more selective. We talked about high yield earlier. We also are have reduced risk in high yield simply because of the valuation argument. We're being more selective. We're owning more senior parts of the capital structure. We're not buying as many new issues as we were 6 months ago. We're owning more investment grade, less high yield. We still like non-agencies a lot, the U.S. housing market, and also emerging markets on a relative basis to us looks quite attractive.
Jim Keenan with BlackRock, Rachel Golder of Goldman Sachs, and Mark Kiesel out at Pimco. Still ahead, the final spread the week ahead. Well, it features in the United Kingdom, they're arguing, and the jobs report here in the United States. That's serious, a jobs report. That'll be a big deal as we move to that December Fed meeting. Stay with us. This is Bloomberg Real Yield. I'm Tom Keenan for John Farrow. This is Bloomberg Real Yield. Well, time for the final spread. Coming up over the next week, Chair Yellen will be speaking, very important speech this week. In Barcelona, the regional government, they hold a referendum. We got a great report on that this week. A really great tension there. And in the United Kingdom, Prime Minister May headlines a conservative conference. And of course, in the United States, we stagger forward to Friday's jobs report as well. I want to go deeper here, or as deep as I can with my brain on floating rate and structured notes. Jim Keenan with us with BlackRock, Rachel Golder, who is all day on the bank loan watch at Goldman Sachs Asset Management, and Mark Kiesel is the Chief Investment Officer for Global Credit at Pimco. Rachel, I really want you to give us some wisdom here. There was a Wall Street Journal blurb this week. Bloomberg had a great article on the frenzy in your world of loans. Describe how institutions buy loans.
Loans are seen as a higher quality, high yield opportunity set, a floating rate opportunity set within fixed income, and basically a safer way of getting yield. There has been massive issuance over the last few years, but most of it has been refinancing oriented, a lot of it absorbed by CLOs, which are doing very, very well.
What's a CLO?
Collateralized loan obligation.
See, Farrow would not have done that. That's a jargon alert, and we're doing that. What's a CLO?
Collateralized loan obligation is a structured product that tranches a portfolio of bank loans.
And is it a floating rate on these bank loans?
The bank loans have a floating rate, and the liabilities are also floating rate.
And now we have a Frank Verbose minute here with Jim Keenan. Explain floating rate versus fixed rate and why you need to float now as you go into 2018.
Yeah, simplistically, it's around the duration risk or your interest rate sensitivity. And obviously, fixed income has a variability of rate risk associated to it. And bank loans give you credit risk, senior secured credit risk that are tied to the front end. And so they float with the Fed funds rate as opposed to, or LIBOR, relative to what you would get in the rest of fixed income. I do think it's important, though. I mean, the bank loans, the senior secured market is giving you a very good risk-adjusted return profile. But one of the things that we did talk about before was the volatility's been low, but dispersion has still been high. So whether you're looking at loans or high yield or emerging markets, the underlying economy at a low growth, there's still a huge divergence between the winners and the losers. And I think that's an important part, whether you're looking at loans or high yield or emerging market corporates, and having a balanced credit portfolio.
Mark, what's so important here is the exogenous shock. Is Chairman Warsh, Chairman Taylor, Chairman Hubbard, can they be an exogenous shock to the certitude of the floating rate market?
Tom, I think they can. I mean, I think under Bernanke and Yellen, we've had a very robust environment for financial assets. You've seen not only bonds do well, but also equities do well. And I think the challenge is going to be, because the global economy is doing decently, and because it's likely you're going to start to see inflation in developed markets start to gradually pick up, the ability of central banks to provide that tailwind for financial markets, I don't think it's going to be as robust as it has been in the past. And by the way, that's independent of the new chair. But the new chair is, I think, going to create a potential volatility for markets. And so it is something that I think is going to be a headwind for asset prices going forward.
I want to go to you with our last question. The non-sophisticates out there say, wait a minute, yields higher, price lower. Is anyone looking for an almost bear market in bonds? Is there anybody out there calling about price down enough where it's painful?
I'm sure there are some people looking out there, but I mean, we're all getting used to the sense of there is a lot of debt in the system. It sits at the corporate level, or it sits in the central banks who are starting to absolutely remove that from the system. But couple that with technology, demographics, I mean, I do think there's a longer-term trend of downward growth and inflation.
This has been way too smart for surveillance. So John Farrell, very lucky to do this each and every week on Real Yield. My thanks to Jim Keenan of BlackRock, Rachel Golder at Goldman Sachs Asset Management, and Mark Kiesel with Pimco as well. From New York, that does it for us. We'll see you next Friday at 12 New York time, 5 p.m. in London. This is Bloomberg Real Yield.